Why would a lithium miner like Livent, ticker symbol LTHM, be trading at an all-time high share price and still be climbing even after it reported a quarterly loss and has flat to tiny top-line growth in a booming lithium market? What is it that investors like myself see in the stock that cannot be understood from its earnings per share or price-earnings ratio? Let's have a closer look, shall we? In my previous video, I spoke about the potential for lithium as an investment. In this video, I want to cover Livent's potential to at least double their share price over the next 2 years. Now, I'm not a YouTube pundit with a fixation for 10x returns. I think excitement has driven valuations of hype stocks in the battery electric vehicle space to such levels that it is going to take years to see meaningful profit on many of them. And as an investor, you're going to need nerves of steel to hold the line in the inevitable pullbacks, which could end up being in the bear market territory for many of them. I believe that Livent represents a relatively low-risk alternative to decent profit margins over the medium term of 2 or 3 years, and I'll use this video to state my thesis. Now, in my investment experience over the years, I've learned to stay away from commodities in general and mining stocks in particular. They are just too damn volatile because their operating margins are insanely geared to the price of the commodity they mine. They are not like companies with branded products. They pull stuff out of the ground, clean it up, process it, and then deliver it in bulk. Their selling, general, and admin costs remain more or less stable throughout. They don't hire marketing departments to brand their coal, or their gold, or their lithium as the greatest products on earth. They don't have aggressive sales targets imposed on people to incentivize them to bang on new doors to get new customers, and they don't set themselves up in new loss-making territories for their end product where they need to reach critical mass to make profit. Like I said, they pull stuff out of the ground, clean it up, process it, and sell it in bulk. This means that changes in gross profit translate to very well correlated changes in operating margin. Pure and simple. Unfortunately, as I found out the hard way far too often before, this knife cuts both ways. When commodity prices drop, your investment plummets. And here comes the but, and I'll throw in a this time it's different. Because it really is. I mentioned in a previous video that lithium is going to be in a structural deficit for a decade at least, which means prices are not coming down anytime soon. So with this in mind, let's have a look at why I have such a high conviction in Livent as an investment, even at these levels. At first glance at their Q3 earnings report, it looks really crap. An operating margin of a paltry 3% and a quarterly loss despite a booming lithium market is hard to justify investing in. And yet, as I said, the share price is rallying. So why is this? Well, there are a couple of things. First up is the nature of their supply agreements. Livent works on long-term supply agreements of at least a year with their customers. This means that their current sales are based on prices that they negotiated a year ago. A year ago, battery-grade lithium carbonate was averaging $8,000 a ton. If we look at Livent's 10Q filing in Q3, we see that lithium hydroxide made up around 50% of their sales and grossed $50 million. Now we know they have a current capacity of 25,000 tons per year, which translates to 6,250 tons a quarter. At this volume, we can deduce that they are averaging $8,100 per ton, which is consistent with what we saw lithium hydroxide sell for in 2020. In reality, it's a bit higher than this, probably closer to $10,000 per ton because they never operated full capacity. And they had reported factory downtime in China, where one of their lithium hydroxide factories is located. Now, on their Q3 earnings call, CEO Paul Graves indicated that all contracts are being redrawn, and there will be no carryover of legacy contracts into 2022. They're also still finalizing pricing and volumes for their new contracts. This is excellent news for shareholders because the current spot price for lithium hydroxide, according to the London Metals Exchange, as of 11th of November, is around $29,000 a ton. If Livent can lock in prices on or around this number, this translates to an almost tripling of their current contract pricing. They're also negotiating for a longer term to provide a bit more stability while they bring their new production capabilities online. Which brings us to catalyst number 2 for the share price movement, which is Livent's capacity expansions. I say expansions in plural because they are adding 5,000 tons of lithium hydroxide capacity in late 2022. But it is their lithium carbonate expansion in 23 and 24 that will really matter. The reason for this is because of this observation. Livent supplies their own lithium carbonate for lithium hydroxide production. A 25,000 ton facility needs around 28,000 tons of lithium carbonate. This means Livent is short around 10,000 tons, assuming they are actually capable of producing their stipulated 18,000 tons of lithium carbonate in the first place. So they have to purchase lithium carbonate from external suppliers. Now, we don't really know how much they are paying for this, but it must be pretty close to spot price given the demand for lithium currently. So this will have a dramatic impact on their cost of goods sold. By my calculation, around 25 million of their 85 million quarterly cost of sale is an avoidable expense once their own production comes online. This translates to around 30% increase in gross profit margins. Lastly, there are what I call the wild cards. 3 of them may have some upside potential. We have their new product line, which they call Livens, which is a proprietary form of a technique called pre-lithiation. Now, as far as I know, the technique itself is not unique, only their flavor of it. This is quite a technical field, but published works do indicate that it has a significant cost and efficiency benefit to battery manufacturers. At this point in time, with the limited amount of information out there, I find it difficult to place any kind of bet on Livex's success or failure. Secondly, we have their stated objective of building up to 50,000 tons in production capacity in the future, but I can find no indication at all on how and when they plan to do this. Lastly is Livent's 25% stake in the Nemaska mine in Canada. This is one of the world's best yielding spodumene deposits, although it has a lot of logistics challenges to overcome, like the extreme weather conditions that are faced mining there. So what does all of this mean for price targets on Livent's share price? Well, I'm not going to put a discounted cash flow model forward here, because I find they tend to be quite subjective anyways and make a lot of assumptions. Instead, I want to point out how geared Livent is to their production volumes and the underlying lithium hydroxide prices. So, by 2024, if lithium hydroxide trades at $25,000 a ton, then Livent will be selling around $750 million worth per annum. They will also be producing a surplus of lithium carbonate, which will get sold on the open market at a price which here I've arbitrarily assumed to be around $20,000 a ton. Revenues under these circumstances will increase by a whopping 109%, assuming all other product sales remain constant. Lithium sales by this point will be a small contributor unless there is an outsized increase in this price too. More importantly will be the impact of surplus lithium carbonate on the gross margins. In 2023, if Livent had to continue importing lithium carbonate, then these costs can reach up to $320 million, depending on when they bring their extra capacity online. Once Livent finds itself in a lithium carbonate surplus, then by my calculations, we should have an EBITDA of almost $5 per share. Now, if you take those wildcards I spoke about earlier into consideration, you can see where the valuation could end up. One scenario worth considering is that Livent might pivot away from some or all of its lithium hydroxide production. The reason I think this is because lithium iron phosphate batteries are on the rise, particularly in standard range vehicles where cost is a bigger issue. Lithium iron phosphate batteries use lithium carbonate as the preferred lithium compound. And this plays nicely into any of the brine miners' hands, as hard rock miners don't produce lithium carbonate as far as I know. But I want to leave this as a parting thought. At current prices, lithium hydroxide is contributing almost $2,000 to the cost of a 100 kilowatt hour battery pack. And Livent is a pure lithium hydroxide player, meaning they don't have a hell of a lot of additional product that would be relevant to a battery manufacturer. Also, they're not bound in any real way to China. They have no Chinese controlling shareholders that I'm aware of, nor do they source any of their raw materials from China. So this is a company that is producing one of the most important strategic metals in the world today, to an industry that is supply constrained, rapidly growing, and margin hungry. How long is it going to take before a battery manufacturer with a vertical integration strategy comes to the realization that they can capitalize 5% of the cost of sale and improve their margins accordingly? All they would have to do is buy Livent out. They'd be able to do this for the low price of Livent's current $5 billion market cap, plus the probably 100% premium most shareholders would likely place on our stock. I'm going to leave that thought there for now because it is pure speculation, but I think it's entirely plausible to think that something like this could happen. And Livent is definitely priced at a point where such an acquisition could be attractive. If you like this content, please hit the like button and don't forget to subscribe to my channel.